Hello everyone and welcome back to another episode of Market Bites. Hope you are all doing well wherever you are listening to this. I'm joined by the dream team again. We've got Nezha and Brett with us. Nezha, I'm going to come to you first as on the screen. You're the first person I can see. So Nezha, first of all, how are you doing?
I'm doing well. I was very nervous yesterday before Alphabet earnings came in, but yeah, I'm doing much better now. How are you guys?
Yeah, no, all good, all good. And actually, we will talk about Alphabet's earnings today. I think we have to. So yeah, we'll discuss that. We'll also talk about software at the moment, which is rightly in the news. A lot of software stocks coming under a little bit of pressure at the moment, and then we'll broaden it out and talk about the broader market as well. Are we about to head into a big sell-off in equity markets? Of course, there's many stocks at the moment that are under a fair bit of pressure, but the equal weight S&P is up. The S&P 500 not even that far away from its all-time high. The Nasdaq, okay, a couple of poor days, but we'll put all that together to discuss that. And Brett, how are you doing?
I'm doing good. I have my Beatles Help coffee cup,
Ooh.
which the software industry could really use a dose of. So
Yeah, they could. Beatles, they've got some unbelievable tunes, I have to say. And their music does make you feel good. I think there will be people listening to this that maybe don't feel amazing about the market right now. I guess there's a few questions, and hopefully we can answer some of those, chuck a little bit of perspective into the mix. Because as we said, I just said earlier, equity markets for the most part are still near their all-time highs, and we are also on the back of a very good run as well. So sometimes perspective is needed a little bit. As always, like, share, subscribe, drop us a comment on YouTube if you're watching, or on the eToro feed. It's always interesting to hear what you are all thinking about things as well. But let's get started with Alphabet, Nezha. And then I guess from like an investor's perspective, how are you sort of feeling about that? I mean, the CAPEX plans were pretty bold, to say the least. What are your thoughts on all of that? Is this smart, or is it a little bit excessive?
That's the main question for this earnings season for many big tech companies, I would say. But yeah, I mean, earnings were good, but CapEx is something that surprised the market, and right now the stock market just opened and it's down about 3% when I checked before recording. But yeah, at the most basic level, this difference between smart investing and overbuilding is whether this spending is responding to real demand or just chasing narrative. And also this is a question, but with Alphabet, I would say that something that really stands out is that demand for cloud and AI is already there, because cloud revenue is growing fast, customers are lining up, and the management is openly saying that they don't yet have enough capacity. So all of this makes spending feel a bit more reactive than speculative, because they, as I said, they already have customers and they're not building first and hoping for customers to show up later. And they wouldn't even know how many customers are out there or something like that. And another thing that matters is how efficiently the money is being used, because Alphabet is not just spending more, they're actually getting better at running their systems. And when spending turns wasteful, you usually see these costs just ballooning and efficiency getting worse. But here we could say that we are kind of seeing the opposite. And it also helps that area that is absorbing the most of that CapEx is Google Cloud. And this Google Cloud is not just like some loss-making growth story, because it's actually profitable, margins are improving, and it's starting to look like real earnings driver. And This gives investors more comfort that infrastructure being built today can generate cash tomorrow. And where investor caution is understandable, I would say it's patience, because markets are far less forgiving than they were a few years ago. All this excitement about AI and just building and burning cash on it, that's gone. And Alphabet is effectively saying that we should trust them now, and the payoff will come later. But investors want to see improvement with every earnings and not just more money being spent. And that only works as long as revenue growth and margins keep backing up the story. And if growth slows down while spending stays elevated, sentiment can turn quickly, crush. Like we saw many stories like that. So for now, I think that this still looks like smart positioning. I think that there are many people out there who would disagree with me, but the margin for error still is way smaller than it used to be. And from here, every quarter is gonna be a check-in whether the demand, efficiency, and profitability are still moving into the right direction.
Yeah, Neja, I think that's a good point with revenue growth pacing above expectations to the idea to justify the spend, because I mean, maybe I'm wrong, but like to me, Google so far in this whole this whole AI movement, Google's CAPEX guide was the one that like blew me away the most from last night. I mean, where they are planning to spend versus what Wall Street was expecting was a huge divergence. But they are, I mean, they're down slightly, I guess. But to me, it's almost like they're being rewarded for it, right? I mean, the stock was up in the after hours, kind of teetering, but it wasn't plunging. And we have seen that reaction to other names. It's like, I almost feel, and maybe correct me if I'm wrong or diverge into it a bit too, but if the company is growing at a rate that investors find acceptable, especially in their cloud divisions, they will reward the spending. If the growth is not to their expectation or to their hope, they will punish the spending. And that reminds me of Microsoft being punished for their quarter. But I mean, what are your thoughts just in general with that idea?
I would say that I agree with your point, and we saw many other companies in software space in last few days being punished for way more than just the 3%. We saw drops for more than 20%. And you mentioned Microsoft. Microsoft was down like 12% last week after earnings. So even though this divergence in Google spending was huge, considering the expectations on the Wall Street, 3% drop is not something I would call punishment for this number. And I think that we could see even bigger drop if market would think that this is really a huge spending that won't be used for future growth, and it's something that's wasteful.
Yeah, I was just talking about the reaction. It's quite interesting where people won't know the exact time we were recording this, so I'll say it's about 25 minutes since the cash open, and actually in that first 15 minutes of the cash open, Google jumped off the lows. I mean, by the time this goes live and people listen to it, it could be trading wherever, but it's an interesting reaction, and it's also quite telling that if we go back to a year ago, literally to the day, we had their earnings from last year, where they ended up dropping and dropped for a while, where they ended up forming a low near the bottom of the market, where the whole market bottomed, but they dropped 32% essentially after their earnings and then a few weeks after. And then from that low to the all-time high, which by the way was literally a couple of days ago, 2-3 days ago, it went up 142%. So even if, you know, the stock comes under a little bit of pressure over the next couple of weeks, not even necessarily long-term holders, because a year isn't that long, but let's just argument's sake, it is. You've massively outperformed the market with that stock, and it's done incredibly well. And I think there'll be quite a few people out there that say, I wouldn't mind Google coming even a little bit lower than where it is now, and maybe that is around $300 a share, or maybe over the coming weeks as the 200-week moving average pushes up, which is currently about $240. Anything around there would be very, very tempting. And the last subject we're going to talk about today is just going to be about the general market. And if that comes under pressure and we do start to see the NASDAQ sell off a little bit more, the biggest companies in the world are also going to come under a bit of pressure too. So overall, I think it was a really solid report, and it did feel a little bit Microsofty, didn't it, where they got punished for what on the face of it was a great report, but then I think the day after or that day they ended up having like one of their biggest ever drops from a market cap point of view, which felt brutal, really. But that is the market, and we mentioned earlier that you're getting punished if you don't exceed everything at the moment. But yeah, we'll come on to the broader market in a bit. But Brett, I think at the moment the buzzword is always AI. And one thing AI is influencing at the moment is the next buzzword, which is software and software stocks and some software companies. How are you viewing this at the moment? It's definitely at the sort of on the first pages of news sites at the moment.
Yeah, it seems like with every time there's a major update from one of these large AI firms, OpenAI or Anthropic, Claude, all these other names. Every time they make this new release, it like crushes these stocks. And this has sort of been playing out in a more limited way with like Salesforce, Adobe. I think people have been kind of like scratching their heads a little bit in the sense of like, well, the estimates keep going higher. And the valuation keeps going lower, whereas they're not being disrupted. Why are these stocks being punished? I think you could have like a healthy debate on that, but these last couple of weeks have really shifted. Now you're seeing everything. If you're tied to software, you're getting crushed. And now, even these last couple of days, it's spilled into other industries. It's cybersecurity. It's been some of the rating agencies, even the exchanges have been hit, like Nasdaq, ICE. You've got all these travel stocks. These guys are getting killed for being tied to technology at this point. And some of that's stock specific, of course, but like to me, software has got to be approaching a capitulation type of move here. It's just the selling's been largely broad based, and if you want to go into the technicals, you've got something like the IGV ETF is coming into its 200-week, which tends to be decent support, just for any type of strong trending asset. But when I look at the space, you see generally, especially the high quality names like a Microsoft or a Salesforce, a ServiceNow, the estimates do keep going higher. Many of these names are at valuations that are either have been a trough for them in the case of Microsoft, or have never really traded this low on a forward price to earnings basis like a Salesforce. To me, I think you kind of have the fundamental and the technical catalyst to say we're probably going to find a bounce somewhere soon. The question to me isn't so much the short and medium term for these names, though. It's the long term. And we were kind of discussing this, earlier this morning in our analyst meeting, but will we see a lower valuation ceiling for these names? So like if these names typically traded between 25 times on the low end and 40 times on the high end, are we going to see that 40 times go down to 30 times now being the new ceiling? And I think that's the threat to software stock investors. And I think that would be sort of the major longer term threat. I don't think these names are going to be eliminated. It's just how will the stocks behave moving forward?
That's also the question that got me thinking after probably our listeners don't know, but we as analysts meet once per every 2 weeks. So we discuss everything that's happening on the market. Yes, and this was one of the questions that some of the analysts brought up, like, are we going to see lower valuations for those companies? And that really got me thinking, especially after those few years that we really saw high valuations, especially in this place, in software companies. And it was kind of a normality to see valuations around 30, 40, and if it would be like 30, a new top valuation for these companies, it could be another era actually, because we are not used to that, but maybe this will be a new reality. But what's happening now, it's it kind of feels like a rotation. I don't think it's the end for software companies. I believe that they will be trading higher in a few years, or if not even in a few months, and this is not the end of software at all. But it really got you thinking when you see those few days when this rotation happens, especially when we got used to those companies outperforming basically every day of the year.
Yeah, and we see this in that meeting you're referencing. Pavel brought up the idea of DeepSeek. We saw the whole AI space get demolished in like literally like one day. And that selling, it intensified over the coming days and weeks. And then AI has gone on to be this, the AMDs and NVIDIAs of the world have gone on to be huge winners off of that sell-off. And or even if we go back to Google for a minute, it's like everyone a year and a half ago, the market was saying that its core business is going to be killed. And it had this terribly low valuation and it was completely undervalued. And now we've seen the whole rhetoric around Alphabet shift. So I think, sometimes these markets get this stuff wrong and we see these overreactions to the upside and to the downside. I do think we're seeing that in software in the short term. It's just a question of how they'll be valued, I think, going forward. Software is not even NVIDIA's Jensen Huang was just out a couple days ago saying time will prove that these names will be fine in the long term. So it's just a question of when, I think.
Yeah, I'm with you. But it is interesting looking at the charts of all these companies, And you look at even your Salesforces or your SAPs and their sell-off has been pretty brutal. But it goes to Nezha's point, if you're a longer term investor, what point does it then get where these are really attractive and you're getting them at, really decent sized discounts? And, I'll just look at Salesforce, for example, now down 3% today or so, but it's trading at its lowest level literally since October 2023. That's, a big move. If it goes back to its all-time high, you're making almost 100%. That's going to be attractive for people, especially if that comes in even a little bit lower down. So it's a very interesting time in the markets at the moment, not just for software companies, but the broader market in general. We talked, I think, last week, I know, Brett, you weren't here, but weeks before where you have been here about gold and silver, the volatility, and that has just been remarkable, hasn't it? And, in other commodities too, and Bitcoin today trading with a number 6 as the first number. For the first time in quite some time. So, yeah, buckle up, people. Put the handbrake on, and it's about to get very interesting.
Yeah, it's gonna be interesting, and it's kind of interesting that we see that much volatility across all different asset classes, not just in crypto space, but in equities, in commodities as well. It's been a tough start of the year, and yeah, Sam, you already told us what the last topic is gonna be, and there have been quite a few comments this week that people are suggesting that equity markets are about to move significantly lower. What are your thoughts on that? Do you agree with it or not?
Well, usually when I see a lot of people saying we're going to go lower, I don't think we are going to go lower, because usually a lot of the people that say this are also calling it about 6 times a year, every year. Eventually they're going to be right. Of course they are. But it was interesting because I saw one tweet in particular where someone was really calling for a bear market, and they'd sold all their positions, 95%, I think they said. And they gave a few different reasons, and one of them was the big IPOs that we've got happening at the back end of the year, and some of the smartest founders that are out there rushing for the exit was one reason. Then they talked about the CAPEX that we're seeing from these big companies and the revenue maybe not quite matching up at the moment. And then you have one of the most famous investors of all time, Warren Buffett, as we know, has been building that cash pile for quite some time, and selling into strength as well, if you like. And it begs that question: what does he know that we don't? I mean, the market had a good year last year, by the way. And then there's sort of debt wall concerns as well, and a lot of people saying it's similar vibes to 2000 with sort of tech to what it is now with AI, and putting that all together, and then the volatility in gold and silver, 1979 kind of vibes there, and then what led to the market. And it feels like, and we mentioned this on the podcast, how we expected January to have some volatility similar to last January, and into the first sort of couple of months of the year. So it shouldn't really surprise us. And also these same kind of comments, a little bit different, would have been chucked around last January too. So I think there could well be a half decent size move lower in the market, but I think it gets bought up, really. I think if you gave that opportunity for people on a 10% dip in the S&P 500 into a correction, I think similar to sort of last April, it'll be bought up. And obviously if the S&P's down 10% or so, the Nasdaq, you'd imagine, would be 15%, kind of similar to what it was last year. But I think that'd be relatively attractive for people. And again, it's quite good actually that we did this podcast just after that meeting you both referenced, the analyst meeting, and Lale was mentioning, a global market analyst, for those that don't know, how the actual overall market at the moment isn't too bad. And I actually saw late last night, and she mentioned it as well, the S&P 500 equal weight is up for the year, isn't it? Actually, I think it was, up low single digits. The S&P at the time of last night was flat. I think it's down a little bit today. So it kind of signals it's just, a bit of rotation, a bit of sort of, I just said the breadth is actually relatively positive in the markets, and quite a few stocks are above certain moving averages as well, which is great, which we haven't seen for quite some time. Small caps aren't doing too bad either. So I feel a lot more positive on things, and I don't think the IPO exits are something to worry about. I think the CAPEX numbers are good, to be honest. I think they should be spending that or looking to use that money, and it's so different to 2000, isn't it? If you look at the companies from that period, like your pets.com always get referenced, don't they? These companies now are actually making money, aren't they? They're doing incredibly well. The issue, I guess, you're going to get, and we've seen it this earnings season, and we saw it last, is when these companies are doing so well and we're so forward thinking, if you don't keep beating expectations, obviously the share price is going to have to move lower, and that can affect the broader market because of a number of things. But I have to say, for the medium to long term, I'm still super positive on the market. That said, it wouldn't surprise me if we do end up with a sort of at some point in quarter one, a 10% drop. But that's healthy, isn't it? Do any of you, Brett, I'll come to you, and then Neja, you can give your 2 cents as well. Brett, do you kind of feel similar, or do you feel like there could be a bigger move to the downside, or, and this is a completely fair answer, do you actually not really know?
I don't think anyone really knows.
Yeah, right.
I mean, I'll preface it by saying we could get a 5 to 10% correction at any time. We get 3-5% corrections a year on average. And even in the fall, we had a 5% correction. And if you were on social media, it felt like the world was actually ending. Yeah. So, the emotions, emotions and sentiment really swing with prices so much these days. But, I think for me, I remain positive. Like if we did have a 10% dip, to me, that's an opportunity. Yeah. And it's, just because the bigger picture remains intact. Most of the points that you mentioned would be the points that I'd mention. I'd also point and say, every sector in the S&P 500 is expected to generate earnings growth this year. That we haven't seen that in 5 years. The economy continues to surprise to the upside. We keep expecting this sort of slowdown, and we're not seeing it. The GDP continues to come in strong. Of course, things can change if, we see labor market breakdown or things like that. Of course, we have to sort of change gears, but just so far we haven't seen it. And, it is kind of, I don't know, maybe startling, a little concerning, I guess, to see the volatility in metals, and then you see the pullbacks in crypto, which so often has been tied to the Nasdaq, and we haven't really seen the Nasdaq pull back that much, especially relative to what we're seeing in software. So some of those things do give me a little bit of pause. But largely speaking, I think that the bigger picture remains intact.
I think that's the most important part, that
Yeah.
the bigger picture is staying the same. And you know what? I always think of times when markets are at all-time highs, and we are still not that far away from
Yep.
those all-time highs. But anyway, when everyone is saying, yeah, all the stocks are going up, everything is booming, and there is so much fear of missing out everywhere on all social media. People are saying, where should I invest? I already missed those opportunities. But opportunities actually lie in those corrections. This is the opportunity to take and invest in those companies that are actually down. And you won't be able to reach those gains when where all the headlines are saying, yes, this stock is booming and we can only go higher. I think that real opportunities lie in those corrections.
For sure. I mean, Google, right? The first company we talked about today. You go back
Yeah,
11 months
definitely.
ago, and people thought it was the end for Google, and then they jumped 140% or whatever it was from those lows. So, yeah, I can understand, people looking at their portfolios and seeing quite a lot of stocks, maybe 20, 30, 40% down from their highs, but the S&P 500 is flat for the year. That can be quite annoying, can't it? And I guess for those people out there, you'd like to hope they have more sort of diversification than that. But remember why you got into those stocks, and if it was to hold for the long term, it might be that they're at places now where you feel like dollar cost averaging in or averaging in on lower valuations isn't the worst thing in the world. So have patience. I mean, also for those newer investors, traders out there, look at the biggest companies in the world and see how many times that they've come under pressure plenty of times before and recovered. I mean, literally just have a look at Alphabet from sort of February last year to April, and then look at what happened after that. So, yeah, I think deep down everything's still relatively okay. And also, the Fed have still got a fair bit of room, haven't they, to work with as well. It'd be interesting to see Trump's nickname for Warsh, should he not immediately cut interest rates. I'm sure he'll come up with something, waiting Warsh or something like that. He'll come up with something. But we'll wrap it there for today. Brett, Nezha, as always, it's an absolute pleasure to have you both on the Market Bites podcast, and we will be back next week. Thank you, guys.
Yeah,
Thank you,
sounds
guys.
good.
Bye.